Hey, good day, everyone. Welcome to our webinar. My name is Brett Salazar, and I am going to be your host as we do every week. I'm very excited to be here with all of you. Last week, we did a webinar, which is the same one that we're going to be covering today, how to reduce and or eliminate your tax liabilities in retirement. And I received 17 calls from people that either watched the webinar live or that were able to get our recordings. And obviously, there's been a lot of questions that I have been asked and a lot of issues and concerns for many of you that are in the process of retiring the next 5 to 10 years. So what I want to do today is I actually want to go ahead and take you to one of the software programs that I use for the vast majority of my clients as we start to prepare for retirement distribution planning. And I think one of the major reasons why this is becoming such a prevalent discussion in 2019 is because of some of the news that we have been hearing over the past few days. Number one, for most of you that may not know this, last week, for the first time in history, the national debt is now exceeding $22 trillion. That's a tremendous amount of money that we're going to have to deal with at some point in time in the future. Now, not only is the national debt a major challenge for all of us, because someone is going to have to pay for this at some point in time in the future, but also the national deficit is fast approaching $1 trillion in 2019. And the national deficit is basically the amount of money that is coming in every single year to the US government versus what they're paying out on an annual basis as well. So last year in 2018, we had a deficit, hovering around $900 billion. And in 2019, for the first time in history, we're going to be at $1 trillion in deficit between what's coming in and what's going out. Now, we have a lot of different programs out there in the United States, and a lot of the promises that the U.S. government have made to all of us that they don't have the money to pay for right now. So, something's going to have to happen in the future. Either we're going to have to start to reduce the benefits that are being paid out as a country, or actually reducing or increasing the taxes that we're actually charging Americans every single year for the rest of their lives. Now, because of the new tax law, and as a tax preparer, we're now in tax season, so I've been helping a lot of my clients and businesses do their 2018 taxes. We're seeing that the vast majority of the clients that are engaged are actually getting a reduction in taxes as of the Tax Cuts and Jobs Act that took effect January 1 of 2018. The problem with the 2018 Tax Cuts and Jobs Act is that it's going to sunset December 31st, 2025. So on January 1st of 2026, when you wake up in the morning, we're going to be back in the old tax law in which taxes were higher than they are today. So we pretty much, because we're now in 2019, we have a 7-year window in which to maximize any tax benefits that we want to take a look at between now and the end of 2025. Now, in addition to that, before I get into the software, another major challenge is the unfunded liabilities that we have in this country. And the unfunded liabilities, as I already stated, are all of those promises that the US government has made to all of us that they don't have the money to keep and be able to pay today. And those promises include Medicare, Medicaid, Medicare Part D, interest on the national debt, and Social Security. So obviously, when you factor all of that debt today, it's actually in excess of $122 trillion. Yes, you heard me right, $122 trillion. Now, in 2020, we're going to have another election year. So obviously, a lot of the pundits and a lot of the politicians, depending on which side of the aisle you happen to be in, they're talking already about raising taxes to 70 to 90% to the wealthy. But the wealthy alone cannot pay all of the tax liabilities, because think of it this way. The top 1% of all income earners in the United States pay 40% of all the taxes in the US. As a matter of fact, the top 10% of all income earners in the US pay 70% of all the taxes. 40% of Americans pay no taxes whatsoever, and approximately 50% of all taxpayers only pay 3% of all the taxes. So the same way that, people may argue that there is an income disparity in the United States, and obviously we're a capitalist society, so some are going to be doing better than others. But at the end of the day, we also have a tax disparity in this country. And, stuff always has a tendency to roll downhill. So that means that for most of us that happen to be in the middle class or the upper middle class, there's a very high probability that taxes are going to have to double in the next 10 to 15 years, or this country is going to be totally bankrupt, because there's no way that we can pay $22 trillion as national debt, that we can try to offset without doing anything drastic, the $1 trillion in deficit, and most important, that we try to do a good job in managing the unfunded liabilities, which today are sitting at $122 trillion. So because of those issues, I felt that it would be very, very important to actually walk you through one of the software programs that I use with my clients, in which we have the ability to do tax forward planning. And because of the fact that we are a tax planning firm, I think it's important to let you know before I bring up the software that there's a major difference. And now that we're in tax season, it is very important that all of you and all of us get to understand this. There's a major difference between doing tax preparation and doing tax planning. See, tax preparation is when you gather all your data, and you take it to your accountant, to your tax preparer, to your CPA, and then he or she is going to look in the rearview mirror, and they're going to tell you whether you're going to have to pay taxes, whether you're going to get a refund, or whether you're going to break even. For the most part, accountants have a tendency to be historians. They love to look in the rearview mirror, but unless you're a tax planner, very few people are going to be able to look forward. So what we're going to try to show you tonight, and this is something that we specialize, here at Gable's Tax Planning Group, is not only looking in the rearview mirror and doing an audit and trying to minimize your tax liability for the current year, but also we're going to be doing tax forward planning to minimize your tax liabilities in 2019, 2020, 21, 22, and so forth. The other thing that you need to consider is that from a business perspective, it is very important that whenever you're making a financial decision, that you look at your decisions through a telescope as opposed to a microscope, because the views are totally different, and your ability to be able to maximize your income in retirement while reducing your tax liabilities is going to be very, very exciting if you do it the right way. So without any further ado, for those of you that happen to be on the call, and by the way, we're actually on Facebook Live as we speak, so a lot of people are watching us. Let me go ahead and I'm going to share my screen, and I am going to go ahead and log into my software so I can walk you through an actual case. Okay, let me go ahead and refresh this again. This is an actual case that I worked on in the very beginning of 2019, and I did the same because I've been working with these clients for quite some time, approximately 10 years. So what I'm going to be doing for you today is I'm going to take you back so you can see a lot of the work that we've been doing for these clients and where the opportunities lie when it comes to the type of business and the type of service that we have been able to do for these particular clients. So let me bring the client in this case, and this is John and Mary Morris, and let me kind of walk you through what we see here. Because what we're using, what you're seeing in front of you is our Tax Clarity software, which is a tax forward software planning that we use. The other thing that is very important for all of you to note is how when it comes to retirement distribution planning, not all income is created equal, as you will see here. So let me kind of get right into the software and kind of walk you through the numbers that I'm going to be sharing with you today. Now, if you take a look at these clients, this John and Mary Morris, they have income of $50,000. Now, this is not the only income that they have. This is what their taxable income will be, was in 2018 and will be in 2019 if we decide to pay any taxes. So think of it this way. They have $50,000 of income, but because of the fact that I've been doing a lot of tax planning for these clients for the past 8 years, these clients are actually generating in excess of $92,000 of tax-free income in retirement that is non-reportable on their W-2s, 1099s, and their tax returns. So what I'm going to be sharing with you today is basically the fact that these clients have $50,000 of taxable income coming into their household today. Now, if you look, let me see if I can be able to annotate this so you can get a spotlight and I can just guide you in a better position. If you notice here, they have $50,000 of income. They are in the 12% marginal tax bracket. Notice here on the bottom that on $50,000 of income, they have a total tax liability of $2,430 for 2018. And they have an effective tax rate of 4.86. So from a business standpoint, these clients are a very, very low tax bracket. And the reason for that is that, you know, the 92,000 and change that is coming in every year to them is actually tax-free, so it's non-reportable in this situation. But the question that I ask all of you, and this is why all income is not created equal, the question that I ask for all of you is there something that we can better the position that these clients are in from this perspective? Now, although they happen to be in the 12% marginal tax bracket, their effective tax rate with all the deductions and so forth is 4.86. Now, notice that between 0 and approximately $26,500, there's no tax liability whatsoever. So that means that that is the increase that we now have on the standard deduction. If you're married filing jointly like these clients, your standard deduction for 2018 is $24,000 as opposed to $12,600 that was in 2017. So you pretty much doubled your standard deductions. Yes, you did lose your personal exemptions, but in this case, the clients are still ahead of the curve as compared to 2017. Now, what you can see here is that in this situation, and let me give you the advanced, you will notice that the $50,000 of income that is coming in for these clients, let me give you the advanced again, is based on $35,000 in this situation. Let me actually go to the base case scenario in this situation, which will now tell you that it was primarily based on $50,000. Let me just walk this to 0. And it was based on $50,000 of IRA distribution that these clients were generating. So you notice that they were in retirement. Now these clients have the ability to pull Social Security benefits, but they didn't want to do so because what they're interested in doing is allowing those Social Security benefits to continue to grow, so that way when they get to the age of 70, they have the compounding effect of the Social Security benefit. So in reality, they have the ability to have a larger Social Security benefit coming to them. You know, most of the people that make Social Security distribution planning fail to take a look at the tax liability of certain Social Security benefits. See, if 100% of your income was Social Security benefits, you wouldn't have to pay any federal income taxes on those Social Security benefits. The problem with the taxation of Social Security benefits is not, and I repeat, it is not the Social Security benefit itself, but it is all the other additional income that may be coming into the household, in which we have to do provisional income calculations in order to determine what percentage, if any, of their Social Security benefits are going to be taxable during retirement. Now, if you do it the right way, 0% of your Social Security benefits should be taxable in retirement. If you don't do it as well, up to 50% of your Social Security benefits may be taxable. And if you really do a horrible job from a retirement distribution perspective, up to 85% of your Social Security benefits will be taxed in retirement. So in this situation, when the clients came to see me, they said, look, Bert, you know, we're doing very well. We're generating $50,000 plus all the tax-free income that you generated on my behalf. So therefore, we feel very comfortable that on the $50,000 that we're taking out of our IRAs, we're only paying $2,430 in taxes for an effective tax rate of 4.86. So I said, well, you know, that's really good. That's actually a, you know, congratulations. That's a really good job, because, you know, you're actually pulling out over $140,000 of income on an annual basis, of which you're only paying $2,430 in taxes. But I said to the clients at the time, I said, you know, what if I can improve on that position? What if I can do something better for the two of you from a taxable standpoint? Would you be interested in seeing some of the things that I have available for you? And they said, absolutely. So I said, okay, so let me go back. I pulled up the software, and this is where we started the conversation, which I'm going to share with you right now. I said to the clients, you know, you only need that $50,000, you know, to mitigate some of the other expenses that you may have. But because of the fact that not all income is created equal, what would happen if the two of you were to start taking Social Security benefits today, as opposed to waiting till age 70? And although they didn't know how that would look like, I said, well, why don't we just go through the exercise? So the exercise that I shared with them was that, okay, they both qualified for $35,000 off Social Security benefits, because I had already done the calculations for them. And on top of that, I said, well, since you only need $50,000 total, instead of having to take $50,000 out of your IRAs, let's go ahead and only take $15,000. So that way, $35,000 of Social Security benefits plus $15,000 of IRA distribution will actually bring you to the same $50,000 that you were earning prior to pulling or changing or making a paradigm shift or doing a straddle between a Social Security distribution and IRA distribution. So here's what we have been able to do just by changing the distribution rates and changing the distribution amounts from different pool of assets at time of retirement. So instead of, if you can see here at the very bottom, in the very first scenario, the green one, $50,000 of IRA distribution generated $2,430 in taxable income for an effective tax rate of 4.86. But just by having the clients retire now and take their $35,000 of Social Security benefit and then offsetting the difference with an additional $15,000 out of their IRA in order to generate the same $50,000 of income, here's what it did. It gave the clients $50,000 of income. Their tax liability went from $2,430. It went down to zero taxes. Remember, these clients are also pulling 92 $1,000 out of tax-free retirement accounts, which include Roth IRAs and 7702 plans, which are cash value life insurance plans that I put together for these clients about eight years ago. So they're actually living on top of the world. Now they're pulling $140,000 a year, and their tax liability is zero. Now, you will say, well, you know, $2,430 in taxes versus zero, you know, that's another 200 and change dollars a month. You know, that can pay a light bill, that can pay for a car payment or a lease payment. That can be added and saved for, you know, a small vacation. That could be reinvested in tax-free vehicles. Therefore, if you don't need that money, then obviously those $2,430 can now go toward savings for future expenditures and so forth. So at least just by calibrating their tax distribution, I was able to get those clients from a tax liability of $2,430 to zero. But I didn't stop there. Because if you recall, when I started talking to these clients, the client said to me, you know what, Bert, you know, we're pulling $140,000. We're only paying $2,430 in taxes. So for us, that's just like a walk in the park. That's free money. You know, we wouldn't mind paying the tax. But then when I said to them, well, if that's the case, if I can get you to a better position, would you want to look at it? And they said, absolutely. But now they realize that they can pull the same income and pay 0% in taxes. So then my next question to them was, well, how much more income can we pull out of the IRAs without having to pay any taxes whatsoever? And for those of you that are listening and watching on Facebook Live, this call, and for those of you that are on Facebook Live, please, I would appreciate if you can make some comments, if you can share, if you can hit like, because that's gonna help us tremendously. But the next question that I asked the clients was the following. Look, most of the time when you put money into an IRA or a 401k, you put the money in pre-tax, the money grows tax deferred, but then when you pull it out, you're supposed to be paying taxes on the whole thing. And now, Bert, you're telling me that I was able to pull $15,000 out of my IRAs without having to pay a single dollar of federal income tax to the IRS? How does that work? How were you able to get that done? And the reason why I was able to get that done was because of the fact I went ahead and put together a tax plan for the clients, a customized tax planning blueprint in which we were able to maximize the standard deductions in order to offset any tax liabilities that may be coming out to the clients from the distributions out of the IRAs. So now the question for all of you, and the questions for all of you that are watching live on Facebook Live is, how much more money can these clients take from their IRAs without having to pay any tax liabilities whatsoever? So you know what? Let's go ahead and do the exercise. So I had the clients in front of me and we were doing a video conference like what we're doing today. So I said, well, let's go ahead and start pulling my additional money. So obviously we're at $15,000 out of the IRA. Let's go ahead and pull $16,000, $17,000, $18,000, $19,000 out of the IRA. We still have a zero effective tax rate. $20,000, we're still at zero. 21, 22,000. $23,000, so let me go back. At $22,000 of distribution out of an IRA, my tax liability and the tax liability for these clients was zero. So ladies and gentlemen, now you have the ability to have your cake and eat it too. You put the money into your IRA pre-tax, the money grew tax deferred, and then you were able to pull it out tax-free. There are very, very few firms that have the ability to do this type of planning for you. But on the other hand, think of it this way. So we're at 0% taxes. In the first scenario, we pulled $50,000 of income we had a tax liability of $2,430. Now we have $57,000 of income, or an additional $7,000, and still no tax liability. So my next question to the client was, well, Mr. Client, we can pull up to $57,000 or an additional $22,000 out of your IRA. Actually, another $7,000 because we had already pulled 15, so we're now at 22. So that's another $7,000. And by the way, the $7,000, the client can do a Roth conversion. So if the clients do not need that additional $7,000, they can do the conversion. There's no tax liability, and they put that money now in a Roth, growing tax-free for the rest of their lives. And we can do this every single year for as long as they have money in those IRAs. So this is an excellent, excellent tax preparation opportunity for all of you on the call. But remember that the client said to me when we started the conversation that they were very comfortable only having to pay $2,430 on a little bit north of $140,000 of income. So my third question to the client was, well, how much more can we take out of this IRA that will get us to the $2,430 of taxable income or tax liability that you were so comfortable with when you first visited with me? So I said, let's go ahead and try it. So I started to pull money out. Obviously, once we hit 23,000, we have a minor tax liability, as you can see here in the red, of $66. I'm going to keep pulling money out to get to the point where I can match that $2,430 in the first scenario. We're up to $868 of tax liability. We're at $1,238, and we have additional income of $15,000. So we've gone from $50,000 to $65,000 of income. Let me continue to move forward so I can get as close as I can to the $2,430. And we're right there. I think we're $6 off. So think of it this way. $50,000 of IRA distribution in scenario one, no Social Security benefit taken, generated $2,430 of taxes to the client. So would have generated $2,430 in taxes to the clients in 2018. By doing some distribution straddles, we have been able to now pull $71,000 of income. So we have been able to pull an additional $21,000 of income. But in reality, because now we have to pay $2,436 of taxes, that gives us an additional $20,994 of income that the clients can utilize. Now, again, that income can go toward vacation, that income can go toward, gifting to family members like your children, your grandchildren. That income can go toward the betterment of their financial life by being able to travel more, vacationing, whatever it may be. That income or a portion thereof can be moved over and converted to a Roth IRA. So now the clients can enjoy tax-free distribution in the future, similar to those $92,000 they're putting today. So they have a much better use of their money because of the fact that they're able to maximize their distribution rate and minimizing their tax liability in retirement by using proper provisional income calculations and distribution straddles. I thought it would be a very good opportunity because I know that obviously the news media is going crazy about the $22 trillion of taxes and of national debt, and what the taxes that they're going to have to pick up at some point in time in the future in order to offset those tax liabilities. So over the next 7 years, because of the fact that everything under the new tax law is going to sunset on December 31st, 2025, at least you do have an opportunity to maximize your tax planning for 2019, 2020, 21, all the way through 2027. Who knows, we are through 2025. We all know that in 2026, January 1 of 2026, the old law is going to take effect once again unless Congress decides to do something else. And more than likely, what they're going to have to do is they're going to have to increase taxes substantially, perhaps 30, 40%, perhaps even for certain tax brackets, they may have to double taxes in order to be able to pay the tax liability. But I think the one thing that I want to leave you with is there are two things that I want to leave you with. Number one, do not allow the IRS to control your tax liability in retirement. That's issue number one. Issue number two, you have a 7-year window of opportunity where taxes are in sale today, because we're actually living in the third lowest tax bracket from a historical perspective in the history of our country. So if you're not taking advantage of your tax liability today, when are you going to do so? Are you going to wait until 2026, 2027, 2028, where taxes may increase, depending on your tax bracket, by 30, 40, 50%, maybe even double what it is today? So it behooves all of you to really do some tax planning. If you're dealing with a tax preparer that cannot do any tax planning for you, feel free to reach out if you have additional questions. Obviously, I'm not going to charge you anything for a video conference, so feel free to reach out. You can call me at area code 786-766-1042. You can also send me an email at Bert, B-E-R-T, at gablestaxgroup.com, and I'll be more than happy to give you 30 minutes of my time, and you can pick my brain, and I can give you some ideas and options that you may want to consider for your retirement tax liabilities in the future. And remember, as we always say, in all the podcasts that we do on a weekly basis, the seminars that we do on a monthly basis, and the webinars that we do here in front of you weekly, that my number one goal and that of my firm is to help you change the way that you see things. Because when you change the way that you see things, the things that you see change. So again, thanks very much for giving me a little bit of your time today. I want to wish you all the very best and have a great week and a great weekend. Thank you, and we'll talk again next week. Take care. Bye-bye.